Hello and welcome to Lecture 5 in the Introduction to Financial Accounting series, brought to you by BNO Chartered Accountants. This lecture will focus on asset accounting using the IFRS framework. By the end of this session, you will be able to understand the definition of assets under IFRS, differentiate between current and non-current assets, explain initial recognition and measurement of assets, understand the concepts of depreciation, amortisation, and impairment, explore basic disclosure requirements. Let's begin by understanding the fundamental concept of what an asset is. According to the IASB framework, an asset is defined as a resource controlled by the entity as a result of past events, and from which future economic benefits are expected to flow to the entity. Let's break this down. First, control means that the entity has the ability to direct the use of the resource and obtain the benefits. Second, the resource must arise from a past event, like a purchase or a transaction. Finally, it must be expected to provide future economic benefits, such as generating cash inflows or other advantages for the business. Classification of assets. Assets are broadly classified into two categories: current assets and non-current assets. Current assets are those expected to be realized within 12 months or the entity's operating cycle, whichever is longer. Examples include cash, inventory, and trade receivables. For instance, a retailer's stock of goods would be classified as a current asset because it's expected to be sold within the normal business cycle. Non-current assets, on the other hand, are held for longer-term purposes, typically more than 12 months. Examples include property, plant, and equipment, PPE, intangible assets, and long-term investments. For example, a factory building or a patent would fall under non-current assets. Recognition of assets. Let's now look at the criteria for recognizing assets in the financial statements, as laid out in standards such as IAS 16, Property, Plant and Equipment, and IAS 38, Intangible Assets. Two conditions must be met. It must be probable that future economic benefits associated with the asset will flow to the entity. The cost or fair value of the asset must be reliably measurable. For example, if a company buys a machine for manufacturing, it recognizes the machine as an asset because it will generate future revenue and its cost is clear. However, internally generated goodwill, such as the value of a company's brand, is generally not recognized because its cost cannot be reliably measured. Once an asset meets the recognition criteria, it is measured either at historical cost or fair value. Historical cost refers to the amount paid to acquire the asset, including any directly attributable costs such as delivery or installation. Fair value, on the other hand, is the price that would be received to sell the asset in an orderly transaction between market participants. For example, if a company purchases a building for €500,000, the building is recorded at this historical cost. If later revaluation is required, fair value might be used to update its carrying amount. This is dependent on the company's accounting policy, of course. Depreciation and amortisation. Depreciation and amortisation are key concepts for allocating the cost of an asset over its useful life. Depreciation, covered under IAS 16, applies to tangible assets like buildings or machinery. For instance, a machine purchased for €50,000 with a useful life of 10 years would have an annual depreciation expense of €5,000 under the straight-line method. Amortization, under IAS 38, applies to intangible assets such as patents or licenses. It's calculated similarly to depreciation, spreading the cost over the asset's useful life. Using these methods ensures that the cost of the asset is matched with the revenue it helps generate. Now let's talk about impairment, governed by IAS 36. Impairment occurs when the carrying amount of an asset exceeds its recoverable amount, meaning the asset is overstated on the balance sheet. To identify impairment, first look for indicators like a decline in market value or changes in the asset's use. Next, calculate the recoverable amount, which is the higher of the asset's fair value, less costs to sell or its value in use. If the carrying amount is higher than the recoverable amount, the difference is recognized as an impairment loss in the profit and loss statement. For example, if a piece of equipment's market value drops significantly due to obsolescence, it may need to be impaired. Disclosure requirements. Disclosure is essential to ensure transparency in financial reporting. For assets, entities must disclose the measurement basis used, such as historical cost or fair value, useful lives or depreciation rates applied, a reconciliation of carrying amounts from the beginning to the end of the period, any impairment losses recognized or reversed during the period. For example, for property, plant, and equipment, IAS 16 requires entities to provide details on additions, disposals, and depreciation expense. Such disclosures give stakeholders a clear understanding of how the company manages its resources. To summarize, assets are resources controlled by the entity that provide future economic benefits. They are classified as either current or non-current, based on their expected usage. Initial recognition is based on cost or fair value, and their value is allocated over time through depreciation or amortization. Impairment ensures that assets are not overstated in financial statements, and disclosure requirements enhance transparency and compliance. Thank you for reviewing Lecture 5 in our series of lectures on Introduction to Financial Accounting. We hope you found this session useful, and please like and subscribe to our channel for more future content like this.